Nation. Greetings to you, Waname, and thank you for joining me in assessing the calculations income tax assessment. Tax year period 2024, which ran from the beginning of March 2023 until the end of February 2024. For a disclaimer, I'm not a tax practitioner. I'll just be going through the calculations auto-assessment. Auto-assessment, yes, auto-assessment. Meaning how much revenue of service, they received information from the employer and other institutions, right? But they did calculation on their end without the person, the taxpayer, the individual themselves filing for this return. They say they brought back those results in the form of notice of assessment. But before you even get to the notice of assessment, there are 4 things that I'd like to browse through. The first one being the tax threshold. The tax threshold is to us, we might be liable for tax. We might be liable to pay tax if the total income received or accrued by the taxpayer within a specific tax year period is above this amount. So you can see on the left-hand side of the table, kind of age group. So for a person or individual who's below the age of 65, and in the tax year period of 2024, total income received or accrued was equal to or above 95,750. They might be liable to pay tax. It will depend on the calculations. Then if you are 65 but less than 74, it's 148,71217. Then for 75 and older, do 165,689. Then the second thing will be deductions. So when they look at the amount that they can tax us on, they say, we have opportunity to reduce that taxable income. We have certain deductions that are allowed to be accounted for to reduce taxable income, which ultimately will reduce tax liability. So one of the contributions is key retirement contributions. So if a person or individual is already making some savings for retirement through a pension fund, whether a retirement annuity or a provident fund, those contributions that were done actually were qualified to be taken into account as a deduction under the taxable income, subject to certain limits, of course. Then you also have donations. If that person, the same individual, actually made donations to PBOs, registered PBOs, during that tax year period, those donations may be, yes, they will be taken into account to reduce taxable income, but they're also subject to what? To certain limits. Then we have other stuff that won't be discussed on this video for now. The thing will be the rebates. So after reducing our taxable income, then they determine the tax liability, how much we need to pay for tax. We have other stuff that we can reduce that payable tax liability, the tax that we're supposed to pay. And those come in form of rebates. The first one, the tax rebate, says to us, or number to buy less than age 65, we are entitled to what something called a primary rebate. So period tax year 2024, amount that thing, it was 17,235. So you are entitled as long as you pay tax or taxpayer. However, take note, if tax liability is less than the 17,235, then primary rebate will also go and match that amount, which ultimately leads your tax liability to 0. However, if it's more, it's just going to end go 17,235. But then if you're 65 and older, then you qualify for primary as well as the secondary rebate. That means 17,235 as well as the 9,444. Meaning these amounts can then reduce your tax liability. And if you're 75 and older, then you qualify for primary, secondary, as well as the tertiary rebate. Crazy, right? That's nice, honestly. Then the third thing, or the final thing, no, this is the fourth one. So this is another form of rebate. This is another form of rebate for those members who are part of a registered medical aid. So if you're making contribution to a certain medical aid and it's only you there, you get a monthly rebate of 364. within the tax year period of 2024. So if it's you and another person, rebate that you qualify for, it's 728. But then if there's additional person on top of it, then it's going to be 728, which is the first two. Then for each additional dependent, they're going to add 246 on top of that each month. So if you multiply that by 12, my God. But now we're getting into the income tax assessment, right? Which is the notice of assessment now. You can see on the right-hand side, we have the details of the assessment, date of assessment, year of assessment, and some other stuff. But then the important part for us is the table below right there, airing balance of account after this assessment. So this table will let us know whether we have amount refundable from SARS to the taxpayer, to the individual, or to the person, right? Or we have amount payable to SARS. But then, if amount that is 0, that means we square up. So if it's a negative balance, it's a refund from SARS to the taxpayer. If it's a positive balance, then, hey, do the right thing, my guy. Pay those people their money. But on this table, on the far right, you can see we have a negative balance of 2,825 and 18 cents. So question now, how did they get to this amount? How did they get to this value? Likely, the notice of assessment always, I shouldn't say always. Let me say most of the time, most likely they will provide calculation for every value that was accounted for in reaching this value right here. So let's get into those calculations. The first one being to determine the total income received or accrued by the taxpayer, by the individual, right, within that tax year period. So we can see on this table their income, we have income income from employment. We also have income from local interest. So local interest, thank you, boss, send a live notification to say this is how much interest you made, or some other investments that provide interest, right? This is the interest that you made, but then it says local. That means investment and savings made local here in South Africa. So for this individual, we can see that they made about 162 rand, right, for that tax year period. And because the merit increment of property divided by 2, they say 81 rand. And that was only for a local interest income, not every income, local interest income. So after that, okay, does the exemption apply? Exemption on local interest income, it says to us, if you're below the age of 65 and the total local interest income received, it's less than 23,800 for that tax year period, then everything then will be fully exempt. As you can see on the far right of the table, under amount assessed, the amount for local interest is 00. So by exempting, because the amount that was received was below 23,800. Then we go back to the whole thing here, employment income. So every value that appears under employment income should be able to appear, with the IRP5, which is the tax certificate that will be provided by the employer to the employee, right, which happens annually. So on this one, we can see another income which is taxable. We have provident fund contributions that are classified as fringe benefits. So fringe benefit, these are the costs from the employer and the different employer firms. So that means these contributions to provident fund are only contributions made by the employer, not the employee, only by the employer towards the provident fund. Then we have other allowances which are non-taxable. So they need to be declared very soon. However, because they're not taxable, they won't be part of the total income that is assessed. So you can see under commutation and adjustment, they were set off against each other. Then on the far right, we have 00. Then moving along to the payment of employee debt. Don't worry about that. Fine. Also form part of the amount assessed. Then we have other general fringe benefits. So also the cost from employer in benefit of the employee. and that will also form part of amount assessed. And that means total taxable income would be 245,174 for this individual, right? So now they have determined the total income for the employee or for the taxpayer or for this individual. Now, what's the next step? Remember, the next step, we're checking if do we have any deductions that we can make to reduce this income right here, because this is where they're going to charge their tax, right? So now question is, do we have allowable deduction? And for this income of assessment, answer is yes, because we have what? We have retirement fund contributions as well as other deductions. Under deduction, normal. The provident fund contribution, which was amount brought forward from previous year, then amount carried forward to the next year. Set off against each other, zero gather. Then we go back to retirement fund contributions. So this one looks into, okay, this taxpayer, this individual, actually, during that tax period, an owner in a retirement annuity and another provident fund, most likely from the employer side, right? So retirement annuity is something that you can take for yourself on site in EFL. And that the total contribution made during that period was 15,972. Then for provident fund, it was contribution to the employee as well as the employer. So it was combination of both contributions, of which amounted to 25,245. So if you combine those amounts together, you should be able to provide 41,217. So those are total contributions made by the employer and the employee, right, in form of saving for retirement. And as you can see, that amount is clearly low. However, total deductions allowed at 41,217. Now, this means this is the amount that we can deduct from total income. So income less deductions, you should be able to give us what? The taxable income, the actual taxable income. So by checking now, we have about 203,957 as taxable income. So question now, how do they get to tax then this amount? They simply go back to what? Their own very table. It has some different tax brackets and the taxable income applicable to that tax bracket. So because that one airing 203,957, but under taxable income on the left hand side, it went under which range? The 203 should be able to on the first part of it, which is area 1 between 1 and 237,100. So tax bracket that this individual is 18%. That means they're going to charge 18% on what? On the taxable income that we can see over here, that 203,957. So 18% that also, that would give us our normal tax, 36,712 and 26. So far, so good, I hope. So remember, after taking into account our charge tax, remember we spoke of what? The rebate, right? So because the individual is below the age of 65, they will then qualify for a rebate double guy of 17,235 rand, which will help us in reducing what? The normal tax, the tax liability, the only tax liability in England, at the 6712. So with the primary rebate, we are able to reduce that tax liability, and then the difference will be able to give us what? The 19,477 and 26 cents, right? So now, one thing that we don't see here is one of the rebates, the medical aid, right? This means then, this individual isn't a member of what? Any registered medical aid during that tax year period. So that's why they didn't qualify for what? For medical tax rebate. So the subtotal that we see there, 19,477 and 26 cents. That was the tax that was supposed to be paid by the individual during period of 2024. However, now they're gonna check it by set it off against what? The actual tax that was received from the employer at the time by every month on the pay slip, there's that thing about a payee, which is pay as you earn. So the total that was received by SARS was 22,352.44. What does this mean? It means that this individual actually overpaid on their taxes. They were supposed to pay 19,477. However, they paid 22,352. So the difference between the two will have to be refunded back to the payer or the individual, which is negative 2,817 rand. 2,875 rand and 18 cents. So that will be that. And the following, that's the summary, which will also be provided on the notice of assessment to say her income was this amount, deductions were that amount, then the taxable income. Then after that, after taking into account the rebate, then I shall take you 1947726, which was the amount or the tax was that this individual was liable for. However, because they actually paid 22,352, there's a refund back to the individual or to the taxpayer of amount there 2,875 and 18 cents. So there will be more about insurance planning and financial planning in upcoming videos. So stay tuned because